Position sizing. The rule above. All rules. The market is not a place that rewards you for how often you're right. It judges you by how much capital you still have after you're wrong. And that's why, out of every trading rule ever written or repeated, there's one rule that sits above everything else: position sizing. You can spend years hunting for the perfect strategy, the magic indicator, the flawless entry, the VIP signal, the insider tip, the system that promises 90% win rate. But eventually, every trader circles back to the same truth. If your position size is wrong, nothing else matters. A trader can predict the trend perfectly and still blow up simply because he sized too big. Another trader can be wrong many times, but if he keeps his size under control, he survives long enough to win in the end. And survival is the real game. No survival, no profit, no career. I've seen countless traders who didn't blow up because of bad analysis. They blew up because they entered positions far too large for their capital and for their emotional tolerance. They want that one trade that changes everything. They think the market owes them a big win because they're confident or smart or understand price action. But the truth is simple. The market owes you nothing. It doesn't care how smart you are, how much pressure you're under, or what dreams you're chasing. It cares about one thing: your capital, and it will wipe it out instantly if you expose it without adequate protection. That protection is position sizing. It's not glamorous. No one brags about risking just 0.5% per trade. People only brag about huge wins, oversized positions, and doubling their account overnight. But the traders who last, the ones who quietly compound, the ones who get truly wealthy, they all know one truth: size, survival, profit. You'll hear someone complain, "I knew that stock was going to rally, but I got margin called." What he really means is, "I was massively oversized." Another trader says, "I was right, but I couldn't hold long enough." Translation: his position size was too big for his nerves. Being right means nothing if your size doesn't allow you to sit through normal volatility. The market demands patience, but you can't be patient if a 12% pullback feels like a heart attack. You can't let winners run if every minor dip feels like the end of the world. You can't cut a loser early if the position is so large that admitting you're wrong feels unbearable. Everything always comes back to size. New traders often think size is only about greed. They think if I double my size, I double my profits. Technically true, but in reality, they also double. The risk of ruin, the psychological pressure, the chance that a tiny mistake becomes a catastrophic loss. Trading is not mathematics. It's psychological warfare. You might feel calm with one lot, but with 10 lots, even if the market moves in your favor, every tick feels like a knife cutting into your P&L. When size is too big, you stop seeing the market and start seeing your money bleeding in real time. You stop following your system and start following your fear. An oversized trader is defeated before the market even moves. He behaves not like a strategist, but like a gambler forced to react, unable to wait. I always say, it's not the market that destroys traders. It's traders who destroy themselves. And the weapon they use is almost always the same: oversized positions driven by greed. It's not lack of knowledge that kills you. It's not lack of courage. It's not a missing indicator or secret signal. What kills traders is one simple thing: a refusal to respect position sizing. A small position can be fixed. A small loss can be absorbed. A small mistake becomes a lesson. But one oversized position, one wrong move, it ends everything. The market does not forgive, and it never forgets. The problem is that most people refuse to think small. They dream of million-dollar accounts, but they don't dream of the 10-15 years of slow, disciplined compounding required to get there. They want the shortcut. They use position size as a way to speed up the process. But the moment they size too big, even if the trade starts in their favor, they're already wrong. When size is too large, you take profits too early out of fear. You can't pyramid properly. You stop leading the trade and start being dragged around by your emotions. And eventually, there's only one way that ends. I learned this lesson the hard way, like every trader who has survived long enough. There were times I was right on trend, right on timing, right on the narrative, and still blew up. Why? Not because I misunderstood the market, but because my position was so large that a normal pullback forced me to liquidate. I didn't go broke because I was wrong. I went broke because my sizing didn't allow me to be right long enough. That's the cruel reality of trading. Being right is meaningless if your size makes it impossible to hold. There's a very simple test for whether your size is appropriate. If you can't sleep, your size is too big. If you have to stare at the chart all day, your size is too big. If you're afraid to close your laptop, your size is too big. A properly sized trader can shut off the screen, go for a walk, grab lunch, hit the gym, and let the market do its thing. That is the psychology of a trader built to last. Another common mistake is pyramiding too aggressively. Beginners get one small win and immediately double or triple their position, as if they've found a guaranteed money machine. But they're not building a fortune, they're building a trap. Pyramiding only works when profits pay for the increased size. If you're adding with house money, it's scaling. If you're adding with your own capital, it's gambling. Even the great traders, the famous operators, never escaped this rule. They took big swings because they had big capital, and because their size always matched their conviction. They knew the difference between bravery and recklessness. Most retail traders do not. The ones who go all in for the big win end up as cautionary tales. A massive trade can change your life, but it never comes from chasing massive trades every time. The traders who capture the big move are the ones who survive long enough to still be in the game when it comes. Survival, chisto, position sizing. Oversizing also leads to another deadly habit, averaging down losers. Small initial positions, easy to cut. Large initial positions, psychologically impossible to cut. A small loss is a bruise. A big loss is a bullet. Position sizing is the foundation of your trading house. If the foundation is weak, any storm can tear it down. I don't care how high your win rate is, how good your indicators are, how perfectly you time entries. If your size is wrong, you will eventually pay for it. If your size is right, you can be wrong many times and still survive long enough to win big when it counts most. Here's the beautiful paradox of trading. Smaller size, higher probability of long-term wealth. Larger size, higher probability of blowing up. Beginners believe the opposite, but trading is not a lottery, it's a profession. Professions require longevity. At the end of the day, the entire game comes down to one word: control. Position sizing is not a tool for maximizing gains. It's a tool for controlling losses, controlling your emotions, controlling your decisions. Greed whispers, go bigger. This setup is perfect. You'll get rich faster. But greed never asks, what if I'm wrong? In trading, wrong happens more often than right. Winners keep their losses small. Losers let small losses grow into disasters. Everything starts with one simple question. With this position size, can I sleep well tonight? If the answer is no, then no matter how good the setup looks, you're already placing yourself in a losing position.